Welcome back to the Global Canadian. It's me, Ruby Chouhan, your International Canada Connect. And today we have a very, very special guest in house. I'm very excited to announce Bassem Fawzy, International Wealth Manager, Accredited Canadian Financial Planner, empowering Canadians, Canadian expats, and families across the globe with wealth management, estate planning, financial planning, education, retirement planning, and more. Today, you do not want to miss this in-depth interview. Thank you so much, Bassem, for joining me today.
Thank you, Ruby, for having me today. Thank you.
Great. I'm really looking forward to it. We're going to deep dive on all things Canadian expats, taxes, wealth management, estate planning, and more. There's a lot of jewels and gems that you will learn and that you probably were not aware of today. So let's get into it.
Let's do that.
Bassem, first, I know that you're a Canadian, one of us. Please tell us, how'd you get to Dubai and what inspired you to come here?
This is the best part about my job. Got the knowledge, got the experience, got the accreditation. Me being expat personally, now I can share personal experience with other expats, Canadian expats. So what brought me here, it was a natural progression of being a professional financial planner. Been in the business for about 30 years in Canada. And I relocated a couple of years back, helping Canadians to plan the next phase of their life.
Yeah.
They work, they accumulate money. We're not seeing much of financial planning advice that guide them through what they need to achieve at the end of the day. Mostly you get a lot of sales, which is really not what we are interested in. What matters to us is what your plan is and how we can help you.
Wonderful. I love that. I think it's so important if you're offering services that you've also lived the experience for Canadian expats and you have that global view on offering services and tools both in Canada and on a global view. I know you've been doing this for many, many years, so you have many examples of concerns, issues, long-term plans, things that people may not even be aware of or think about. I think it's a very key item to discuss. Even myself, I'm not sure about estate planning or wealth management or where to put my funds or where to place my funds so I can get a return long-term when I retire. And sometimes I think this area is very scary for individuals, especially when we weren't really taught this in school in Canada. Our banks, our financial planners there, they never speak to us about long-term goals and plans. They typically say, put your money in this stock, I'm gonna get 2% back, etc. And you are unaware, but you hand your money over to a bank. So tell me a little bit more about the types of services you offer. How does the process start if somebody comes to you?
Well, thank you for this. It's a good question. And I may not be able to stop talking about
That's
this
okay.
part.
We want to hear.
So the first thing happens when I first meet my client, a key important thing that I tell my client, we're not doing anything today. We're talking.
Yeah.
I just need to hear everything about you. It's important that we talk. It's important for me to understand what are your goals, what you want to achieve for yourself or for your family, for protection, for your retirement. So all these things that I need to understand your situation. And from there, we bring down all this big picture to smaller boxes that we address and deal with each one individually. However, they are tied to each other at the end of the day. For example, our discussion, the most important thing to you, let's say maybe it is retirement, right? This is something that we, deep dive there to find out what's your lifestyle going to look like. From a health-wise, are you planning to travel the world? Are you planning to stay at home? What are your plans and how I can help you achieve that? Now, it's never down to a product. I want to be very clear about this. Don't expect me coming up with saying, oh, this is the product that works for you. I always tell my clients, we'll find the product falling from the sky on us because this is what fits, right? So, and that depends on the situation. It could be retirement. You might have children going to university in 5 years, 10 years, 15 years, 20 or more. Well, not 20 years, but 17 years. Yeah, exactly. It could be anything. Let's take a look at the average cost now. And being here, so our children may not necessarily go back to a Canadian university where you have the privilege and the benefit of being Canadian resident and getting all the the residence
Very good
cost.
point. And just to add to that, typically as a Canadian growing up or when you have children, you get an RESP and you put your funds into an RESP and you receive some grants from the government.
20%.
But based on our conversation and what we're seeing now, the world is a very global place. It's a small place and it's a very global place. There's Canadians all over the world, whether they're moving to Dubai or Spain or elsewhere for retirement or for work purposes. Now let's imagine you've relocated your family here in Dubai. You have kids here. The kids are in international schools. You have your RESP back in Canada, which I don't believe you can avail if your kids are not going to school in Canada or specific international schools. So people need to think outside of the box and think of where else can we put our funds for our children's school, education, or our own retirement, because we may have the funds in Canada, but we may not. Maybe we don't want to keep the funds in Canada. It may not be as beneficial. So the good thing with you, I know, is you have a global overview of different locations to invest and return. And I would love to hear more about that.
So, since you mentioned the RESP as a product, as an account that help Canadian grow the money to help the children to pay for their school or post-secondary education, there are also other products available. You don't get the grants, okay? But again, let's not forget one thing. The majority of things that we work with internationally they are not attached to any tax liability at the end of the day. So even if it's a fixed income product, the providers had made sure that it's structured in the sense that you have the taxes don't go back at you. It's structured this way. For the children education, there are specific accounts that actually will do this for you. Okay, you're not going to get the 20%, but in return, you get the protection from the market downside. So there are so many things. It's much, much, much more complex than what it is in Canada. That's why it took me the entire last 2 years examining what is here and what works for us as Canadians. Because one thing always on mind, the majority of us are going back home. Okay. And what do we need when we go back home? Our children may not go back home. They may go to somewhere in Europe. They might go to the US to study. They may go, the world, as you said, is big. People go different places. So your plan, it has to be as big and as complex-ish as the world coming upon us.
I love that, because Bassem and I have spoken in detail off camera about all these different retirement tools, education tools, etc. And as a Canadian myself, the only thing I think of is RESP, which we're not aware of what's out there. And it is an in-depth conversation. It's not a 5-minute conversation. And I love that you are very transparent and you educate your clients and individuals, whether they're your client now or in future. It's about education and transparency and choice for the individual. So I'm definitely going to have another conversation with you off camera, talking about all the different possibilities and products. So I really appreciate that, because anytime I want to help my clients out, introduce them to someone, I want to feel confident that the person is not in it for themselves. Of course, we all want to help everybody and help ourselves too, but the goal is really helping the individual understand all their options.
Financial literacy is a very important topic, very near and dear to my heart. In fact, this morning I was at the kids' school and I signed up for some event, right?
Good dad. And, good dad over here.
Yeah. But then again, I told him, hey, listen, I'm not bringing cookies to sell. I'm not bringing anything that is tangible. I'm just bringing some little games for financial literacy to help our children to understand it. So they liked that so much, and actually invited me for another session come March. So it's a very important topic beyond the planning. This comes before the planning, the financial literacy. You'll be surprised. We're all adults and there are things that we're still not aware of.
Absolutely. Right? Well, they don't really teach a lot of financial literacy options in colleges and schools. We need that. And I think when you mention kids, it would be great to have some kids guided, children guided literacy programs, financial planning, so it can motivate them to be educated and learn for the future.
And also remember, the children today are not like the children back in my day. Right? I just met someone a couple of days ago. He shared a story with me. Actually, he was one of my colleagues, that his friend, a 22-year-old, created some app and sold it. And before you know it, the 22-year-old has something like $25 million.
Oh yeah.
Boom,
Yeah,
just like
definitely.
that.
Definitely.
So you go back and you just Google this, don't take my word for it. See how many very wealthy celebrities and athletes have gone belly up. They bankrupt because they did not have the proper financial advice and financial guidance.
Yeah.
We try to avoid that for as much as we can.
Yeah.
And financial literacy, financial planning are keys to help the young ones moving forward to the next phase in life.
I agree. And that's such a good point because, as you know, I help clients, Canadians, move across the world a lot to Dubai, GCC area, Qatar, Saudi. And the range of my clients, I used to think it was, 35 plus, more established family individuals. I have clients who are 20 years old,
There
21
you
years
go.
old, millionaires
There you
who set up, online companies, crypto platforms, all these different things. And of course, we always say experience is gained through years, but these individuals are having that experience during their early years of life. And now they also need to add in the financial literacy planning. They need the right people on their team. I always say, whether you're a Canadian expat or anybody, life is a puzzle and you have to figure out all the pieces because otherwise, puzzle might be broken. There might be pieces missing and you want to make sure it's comprehensive.
A few years back, for some reason, okay, it was not intended, for every couple of months, I end up having a client who won the lottery, the
Oh,
649.
wow.
Yeah.
Amazing.
But the one of them that really resonates, he won $1 million, right? And he was a carpenter. Okay, so he doesn't know much in how to manage his money, what to do, and this and that. So the gentleman sat down with me, him and his wife, and we planned for it. And the first question: so now that you won the 649, what are you gonna do tomorrow? He said, I'm going to work. I said, okay, what else? He said, I'm gonna go to work. He said, tell me some more. Like suddenly you have a lot of money. I really want to know him inside.
Yeah.
He said, absolutely nothing. This has just happened. This money is going to stay there until I retire. And if I die, it goes to my kids. They have better life. But I worked hard for this life that I have, and
Yeah.
I'm proud of it. And I want to maintain this life.
Yeah.
It was a really a good aha moment that money can change people. Back to the 20-year-old that, overnight become millionaires. Or I believe he was in his late 40s, early 50s. That just didn't change anything, despite the fact that he doesn't know much of what to do, but he leaned on professionals to help him out.
Yeah, and I'm assuming based on what you said, he probably already had a conservative approach. He wanted to place his money, probably wasn't sure where to place the money so that he can get a return long term. Imagine he just put in a savings account with very little interest or no
It would have
interest.
eroded by now.
Oh, okay, oh wow.
Yeah, with
'Cause the
inflation.
value of
Oh,
the-
yeah.
Oh,
He put
yes.
$1 million, of course, it would have grown, but the value of the money would have
Yeah.
would have deteriorated over
Yeah.
the years.
And that's why it's so important to diversify and put the funds in a correct place and get the perfect return and learn
So
all
in
that.
that platform, you have to diversify. Of course, we have our local banking system that we all need.
Yep.
However, for your international presence and international growth, there are other platforms that we work with. It's still got the safety and the security and the compliance that we still work with.
Yeah. Amazing. Amazing.
So now let me ask you, enough about me for now.
Okay. I mean, very interesting. It's very interesting, and I want to deep dive into that brain a little bit more, to be honest.
Okay, well, this brain got a lot to bring out. Tell me, so now I was living in Canada, happy, no problem, paying a lot of taxes and
Yeah.
every single thing I do. And now that I'm here, what do I need to do either to protect or to file my taxes every
Be
year?
compliant.
Yeah, be compliant. What do I do?
Great question. Great question. I'm very happy to answer. As you guys know, I'm founder of 360 Global Tax. We assist Canadian expats and non-residents with departure planning, tax residency, post-departure tax requirements, filings, withholdings, etc. I have a few comments to make on this. First, let me explain why it's so important to figure out your non-resident tax status, when you become a non-resident, what that means, etc. Number one, especially if you're moving to a low tax country where, for example, in UAE, there's 0% personal income tax. There's many other countries with zero or very little income tax as well. If you're still considered a Canadian tax resident, that means that the CRA, Canada Revenue Agency, has a right to tax your worldwide income, which would be awful. The whole reason,
Even if I'm working here and
even
making
if
money
you're
here?
working here,
Really?
because you're a Canadian tax resident, until you are declared a non-resident for tax purposes. And everyone's situation is very different. So we need to review your whole situation. We need to review your ties, secondary ties, your lifestyle, because the world is a very global place. People have employment from multiple countries. People have property in multiple countries. People are moving across the globe, spending this much time here, that much time there. We also do a very thorough overview and learn the client's situation. Now, let's imagine they are considered a non-resident for tax purposes based on their minimal ties, their permanent move, a whole number of factors. We typically have to file something called a part-year departure return. It's different than a regular tax return. It has, for example, it reports your emigration date. It reports various asset ownership. It reports property ownership. As an example, if you fail to report your property ownership and the fair market value, CRA has a penalty of $2,500 plus arrears interest for each taxpayer that owns the property. There's also reporting of non-registered investments, something called a deemed disposition that happens. But the key thing is, it's so important everything is filed correctly, all the T's are crossed, I's are dotted, so that the CRA is not coming after your worldwide income. When that happens, only Canadian source income is taxable in Canada, meaning your hands are crossed, everything's exited correctly at the CRA. We manage that for our clients. We become representatives. We deal with the CRA. You don't have to worry about calling them while living 13 hours away and all these things. Once that's done, you only have to deal with Canadian source income afterwards. That's the main reason that it's important to figure out your non-resident tax status. Other things are, as a non-resident, you're no longer eligible for various credits such as, or benefits such as climate incentive benefit, GST, HST credit, childcare benefit, etc. You know, a concern happens where someone's been misinformed and they come to us after 3-4 years or even 10 years and they've been receiving all these different credits, thousands and thousands of dollars. Now we fix their tax filing. CRA is aware they were a non-resident for a number of years. Now they have to repay benefits. They might have had different penalties for failing to withhold tax with another division that comes into play, etc. So come to us. What we do is a step one. As you're planning your departure, we review your whole situation. We go over all the implications, primary ties, secondary ties, investment income, pension income, rental income, sale of property income, exiting the Canadian tax system, non-resident filing requirements in case you're earning pension or other sort of income as a non-resident. And we make sure all the T's are crossed, I's are dotted. And, you know, right now I speak to about 15, 20 people a week who are leaving Canada to across the world. So I think a long time ago, it felt like a foreign dream, something that was very out of the ordinary for someone to leave Canada, whether it's for 2 years or 20 years. We don't know what the future might hold. But the world is changing and many people are moving
100%.
abroad. So we help with all that. I hope that helped answer your question a bit.
Absolutely.
Yeah.
Absolutely.
Yeah.
It's very clear that once we leave, we have to do something.
Exactly.
Like there's something need to be done.
100%.
And that's basically to decide whether I want to continue being Canadian resident and end up continue paying taxes. This is what I understand. Or stay, here. We're not paying taxes, but we just need to file to let CRA know, back off.
I like the way you said that. I'm going to correct your wording a bit.
Thank you.
Yes, because often individuals think it's a choice. I am deciding if I am a non-resident for tax purposes or not.
Oh.
It's not a choice. It's based on the facts of your situation and your circumstances. Let's imagine, based on your circumstances, you're actually a non-resident instead of a tax resident. That means you likely have missed out on your departure filings. If you're earning, let's say, rental income or pension income as a non-resident, there's other divisions that come into play, such as it's called a Part 13, a non-resident tax division. They're going to assume you're withholding and failing to comply with their requirements, which could result in hefty penalties, often 25% of, let's say, the gross rent on rental income and things like that. So I wouldn't say it's a choice. It's based on your circumstances, and the correct filings and items should happen based on your circumstances. Yes.
Okay,
Yeah.
thank you.
Which is key because often there's a misconception when someone leaves and they say, oh, I'm just thinking about moving abroad for a few years, 3, 4 years, I might come back to Canada. Well, that's okay. You have short-term plans. However, you may be a non-resident for tax purposes for those 2, 3 years instead of a tax resident. Imagine you move to Dubai and you're up in the air about your tax residency status. You're unsure, but you're making, imagine you get a great job here. You're making 150K, 100K Canadian, whatever it is. If you're considered a tax resident because you've chosen to be a tax resident,
Then you pay.
then it's taxable. Whereas if you truly moved or your ties are cut, all these different things have taken place, and now you're residing in UAE, likely, I would assume you're a non-resident. We have to review your whole situation, but you want to be correctly marked so that you are not required to report your worldwide income and it's not taxable. Imagine you're paying 40% taxes or even 50%. The more you earn, the more you're taxed in Canada. Where here, let's say you make 100K, Canada 40K would go to taxes approximately. That 40K would be in your pocket here. So it's very important that your tax status is correctly updated, the correct filings have happened, etc. And then if you decide to relocate, repatriate back to Canada, we would do something called a part-year arrival return. Typically, when someone becomes a non-resident or they return back to Canada, the year is split into 2 periods, resident period and non-resident period.
Right.
We ignore the 183-day rule. Don't look at the 183-day rule when it comes to when do you become a non-resident for tax purposes. And so the 2 periods, imagine you became a non-resident, everything is done clear May 1st. That means for the resident period, your filing, Canadian filings, report until May 1st, until you were a tax resident. Afterwards, if there's any sort of non-resident income, depending on the sort of income, there's different sorts of tax returns. Non-resident pension income has a different sort of tax return called the S217 non-resident return. And as a side note, if you live in a tax treaty country, you have the option to file a form called NR5 that allows reduced withholdings. If you are in rental income, there's various tax withholding and filing requirements on that too. So it's really important to know when you become a non-resident because all these other tax filing withholding requirements may kick into play, and we don't want you to miss those and have to deal with penalties and going back years later and fixing that. We help with that, but we want to help you right from the beginning as well. So everything is clear, correctly filed, T's crossed, I's dotted moving forward.
Okay.
Yeah.
That's like do it basically once you made the decision, just see you and take care of business so we don't have to deal with it later.
Exactly. We want to review your situation so we can properly advise you when do you actually become a non-resident, what are the implications that you need to deal with moving forward so that everything's taken care of. And we comprehensively manage that because we know our clients live across the globe. We put our mailing address on everything. We express mail everything. We become the representatives at the CRA. You never have to call them. Unfortunately, CRA often makes mistakes and there's issues and timeline issues. So we stay on top of that for all our clients across the globe.
Speaking of which, now when you're telling me about the time, now when I was on the other side, when I was in Canada, I had a client, he's living here, okay? He has a TFSA there, okay? And contributing as usual until they found out.
My inner tax self is freaking out right now. Sorry. Yes.
Yeah, exactly. He had $30,000 penalty.
I think we might be talking about this. I don't know. I have another client that just got a $29,000 penalty. So it's very unfortunate.
That one was $30,000. And the pain to even just to pay it and clear, it's like, okay, it is what it is. I'm going to pay it, get off my back. And it took him like a couple of years to get this done. And, you think, okay, this is the penalty, pay the penalty and move on. Actually, it's more complex. And then you got the routine, you got the red tape and this and that. So, yeah, I would not want to see anybody in that situation. It like he lost sleep for a while.
So talking about TFSA, tax-free savings account, when you become a non-resident, you are no longer allowed to contribute to your TFSA because that tax-free benefit is for tax residents. If you contribute as a non-resident, there's a penalty of 1% per month plus arrears interest until those funds are withdrawn. However, if you already have a TFSA and you're planning your departure and you haven't moved yet, perhaps you want to be strategic and you can put the funds into the TFSA,
Maximize it.
maximize your
Get
TFSA
your limit,
room.
maximize it.
Exactly. Before you leave Canada. In the future, it's interest-free, any withdrawals that you take from there. And then once you decide to move back to Canada, your TFSA room
yours.
continues to grow.
Exactly.
So it's not that you necessarily need to withdraw from all your accounts or anything like that. One tip, in UAE, we don't have to worry about this. In Saudi, we don't have to worry about this. But if you're moving to, let's say, Spain or another country that's high in taxes, often some countries won't recognize the TFSA as a tax-free. So it doesn't become, it's no longer beneficial for that taxpayer to hold that TFSA because other countries may tax unrealized gain even in TFSA. So
Really?
wherever you're moving, especially if you're moving to a country that does have taxes, you need to learn on the Canadian side, yes, but you also need to explore the tax rules and implications to the country that you're moving. Luckily, we don't have to worry about that in UAE for personal income taxes, other than if you're looking to set up a business, etc. But yeah, I'm so glad you brought up the TFSA.
And the other thing, if I might add, when you leave, do not liquidate your assets. So I've heard and I've seen some clients, because due to they don't have the advice, they just went ahead, they did not cash out their RSPs, but they're just staying in a cash position because they thought when they leave the country, they have to liquidate. You don't have to liquidate now. You cannot make any more contributions, just like Ruby said. But having said that, keep your investment as is, as long as it fits within your financial plan and your long-term objectives and goals. Just leave it alone.
Yeah, and actually, so typically TFSA is the one you cannot contribute to as a non-resident, but as a non-resident, you can still contribute to non-registered investments. Different companies allow non-resident account holders, such as Questrade allows, Wealth Simple, Nesbitt Burns, I believe, do not allow non-resident holders. And it's not necessary for someone to liquidate other non-registered investments. So when we hear about departure tax, people are like, oh my God, I'm scared. I'm going to have a big hit of departure tax when I leave Canada. Departure tax is typically on non-registered investments. CRA sees you having a deemed disposition when you leave Canada, meaning they're seeing you sell it and buy it back at fair market value, even though you're not realizing or having cash in hand and really selling that investment. So you have to pay departure tax when you leave Canada on the capital gain. Let's say if you sold it versus had the deemed disposition, you'd be paying tax on the capital gain. However, imagine you become a non-resident, you've paid some tax on the capital gain upon your departure. Afterwards, you don't have to worry about paying tax on the capital gain. So it can actually be beneficial for sometimes non-residents to continue investing in their non-registered investments because they're not paying tax on capital gain at that point.
I have a question, but wouldn't this also help in adjusting the cost base of the investment?
Deemed disposition?
Yeah, if a deemed disposition, that brought me from 100 to 120.
Now
so
they
now
pay
the
tax.
cost, and I pay tax, so now my cost is 120.
Yep.
So if I sell in the future as resident, then it's a lower.
There's a difference between when they departed and when they came back. Now, ideally, they're going to want to sell as non-residents so that they don't have another deemed disposition. And this ties into, we had a wonderful conversation about different products and items that are available for Canadians from Canadian financial institutions that are not available to actual residents in Canada. And I was so shocked and surprised because I didn't even know they had the option to do that. Well,
again, the money market or the international market is really big. And our Canadian institutions are powerful, on a global scale.
I had no idea, actually.
They are. Yeah. They are. And because of regulations in Canada and the political landscape, the financial landscape, I can't speak of that. Some things are not allowed to be sold to Canadian residences. So as I mentioned to you on the call the other day, I had a client that actually we found this client is not qualified to work with us, period. Just because this is a Canadian resident person, right?
They were still a resident over there.
Exactly. Still a resident over there. I don't know, they're actually living there. That's why I cannot work with someone who's living in Canada. at all.
Yeah.
Okay. So the Canadian financial system articulated few products, whether under the insurance landscape or the other levels of investments. Originally, these were designed, they were in the Far East
Okay.
for the ultra high net worth individuals. And because of the rising of wealth in the region, these firms brought us their products. So it's
Interesting.
not a product that you can just knock on the door or call
Yeah.
your local agent to get it for you. Those are specific for ultra high net worth individuals. Without getting into details, without promoting anything, but since we're talking, so here's one of the plans, and it's an insurance policy, life insurance policy, that you have your premium for so many years and you're done. So it's not a policy that you pay for it forever, right? For so many years, boom, done, and it's paid. If something happened to you or to the person in between, they get the benefits. Nothing happened after the premium. Now we have the growth period. So actually, the policy has cash value, and it grows, and it is invested. We're talking S&P. We're talking proper investment, not just a GIC level. And at some point, you can turn this also to income. Like it's not an RSP.
Yeah.
Right? It's not an RSP.
Yeah.
There are no tax implications coming
Yeah.
or going. However, it's one of the Canadian companies that created something like this.
I need education in this area too, because when I think about long-term health plans, health insurance, I never think of I can take the cash out of it for retirement.
It depends. It's not a blanket statement.
Okay.
But I'm just giving an example of some specific products that work for high net worth individuals that is not available to the retail client.
Yep.
We don't work with retail clients.
Yep.
And they fit in perfect on the long-term plan of clients. Because now that we're talking insurance, for example, how can I create a long-term plan without looking on your protection, your health, and your family and your life? Because someone can get sick, diagnosed with a critical illness, well, everything, life will turn upside down.
Yeah.
So different products to different people. And again, it's not a product environment that we work in.
Yeah.
It's a solution environment that bring you where you want to be.
Yeah, absolutely.
Some people don't care for this part, rightfully so, as long as they're fully aware. And some people, it's important they understand. If something happened to me now, like, what am I going to do next?
Yeah.
Right? Okay,
Absolutely.
I have $1 million saved. If I get diagnosed with terminal illness and I'm here, I have no help to take care of me. Okay.
Yeah.
I have my company insurance, but how far this can take you, right?
And typically that ends when you end employment with the
There you
company
go.
insurance. And knock on wood, we're all aging. This is part of life. We all get sick at some point. Something is going to happen, unfortunately, and we do have to plan for that.
I'll share with you at some point some statistics coming from local insurance companies, and we all have different level to be diagnosed with something.
Yeah.
Right? Some of us may get nothing. Some of us may. So.
Yeah. Very important.
Ruby, question for you. I get a lot of Canadian clients moving in, and we help them out, establish themselves and financially plan their, high income versus, and savings and what to do the most with their savings and so on and so forth, get them on the right track. Now, almost always, these clients have a property in Canada.
Yep.
Okay, and the question always comes, what do I do with this?
This is a great question because real estate is a huge topic that we cover when it comes to taxes. And I would say 95% of my Canadian expat clients keep their Canadian real estate.
Okay.
We have foreign buyers taxes, non-resident speculation taxes in Canada, but those are for foreigners. Non-Canadians is the wording by the government, meaning if you're still a Canadian citizen, which typically everyone keeps their citizenship because immigration status is different than tax status. It's much easier to keep your Canadian real estate, grow your real estate portfolio while living abroad, take out equity, purchase more rental property, etc., in case you decide to have it for your children, move back to Canada in future and have it. What I'll say, a few items. Typically, let's say someone has their principal residence. Now they're leaving Canada, they turn it into a rental property. One thing is there's a principal residence exemption in Canada. Anytime you're a tax resident of Canada and you live in the property, you don't have to worry about capital gains tax. And the principal residence exemption, there's a plus 1 year rule, which is great as well. When you're a non-resident, you can no longer avail the principal residence exemption because it's not really your principal residence anymore. So now let's say you've converted it to rental property. And before we even go into rental property, when you leave Canada, we are required to declare property ownership, like I mentioned earlier, specific form. It's called T1161, List of Properties by an Immigrant. It's for disclosure purposes only. We have to disclose the fair market value. The good thing is there's no tax payable on capital gain when you leave Canada. If there is tax payable, it's during the eventual sale of property. So let's imagine now you have a rental property. There's a non-resident division that comes into play, and you cannot skip the step of withholding non-resident tax on the rental income and just file a tax return, because the Part 13 division will assume you're failing to comply with the withholding requirements and issue a final tax assessment of 25% of the gross rent plus arrears interest, which is huge.
That
so
hurts.
we don't want that whole
No.
25% to be the final tax requirement. So Part 13, they give two options for non-residents to withhold tax. First option is default 25% of the gross rent, paid every single month to CRA. Imagine you're earning $2,000 a month. That's $500 per month in tax, $6,000 in a year. CRA is holding on. It's a lot of money that you could be using elsewhere to pay bills, property taxes, mortgage, etc. That's option one. And I'm not going to deep dive into it because less than 5% of people hold 25% of the gross rent. People do not want their money tied up with CRA. Option two, which our tax firm offers, is called Form NR6. Essentially, you must have a third party, such as our accounting firm, registered as a non-resident tax withholding agent. And this Form NR6, it's almost like an estimate rental tax return. And it estimates your net rental income. And by submitting this form, you sign off on it, we sign off on it, we take on a lot of liability as your Canadian tax withholding agents. It allows you to pay 25% of your estimated net income. Imagine you're estimating a loss. You can end up paying $0 in tax upfront to CRA. So process is broken down to three parts. Part one, we prepare your NR6 form, we express mail it to the CRA, we put our mailing address, etc. And it allows you to pay reduced non-resident tax. Until the form is filed, you have to pay 25% of the gross rent. So ideally, this form is submitted before January 1st or at the beginning of the year, so you're approved for the whole year. Now, NR6 form is filed. If there was a payment due, you make it to our non-resident account. The rest of the year while you live abroad, no more forms or payments. You don't have to worry about anything. We manage the approval with CRA, etc. The following year, we prepare a non-resident tax slip, NR4 slip. It'll show that there was an exemption for you to pay reduced tax compared to 25% of the gross rent. Step three, as a non-resident, there's a specific return. We call it the S216 non-resident rental return. It reports Canadian rental income and Canadian rental expenses only, because at that point, you're not required to report your worldwide income. If there's other sorts of income, there's different sorts of non-resident returns. On this tax return, the good thing is almost everything related to your rental property is tax deductible. Leasing fees, property taxes, mortgage interest, which is a huge expense, accounting fees, maintenance and repairs.
These days.
Oh, definitely these days. I think mortgage interest is typically the largest expense anyone has. And then you're taxed on your net rental income. However, when you have a NR6 form approved, CRA has a very strict tax filing deadline of June 30th of the following year. And if you fail to file your tax return, they cancel your NR6 form and they come after our tax firm as your Canadian tax withholding agent for 25% of the gross rent plus arrears interest. So we have this process set up very well in-house, and we help many, many Canadians across the globe comprehensively manage this process. So people are keeping their Canadian properties, leave it up to the tax experts to manage all the filings, forms, requirements. Our goal is to help you pay as little non-resident tax up front, ensure all your expenses, deductible items are included. So at the end of the day, you're paying as little tax on the net rental income. That's the rental aspect of it.
Wow.
Yeah. It's any questions?
No, I'm good.
I explain this often. I explain this quite often.
I'm good.
I wake up out of my sleep talking about non-resident taxes. And selling wise, Actually, a lot of Canadians are surprised. They come across this after they sold their property and they're not aware. But as a non-resident selling Canadian property, and let me actually use the word disposing of Canadian property, meaning selling, transferring, or gifting, there's a process called Certificate of Compliance Application and Non-Resident Tax Return Requirement. What that means is Certificate of Compliance applications, they must be filed within 10 days of the closing. There's penalties of $2,500 plus arrears interest if you fail to file the applications. These applications include various forms, if it was principal residence, exempt residence, rental property, etc. At the same time, and this is the key thing, your real estate lawyer is required to hold 25% of the gross sales price in trust. If you sell for $1 million, 25%, $250K is with the lawyer in trust. We don't want that money being sent to the CRA. It takes a very long time to get money back from the CRA. CRA starts working on the applications. They request a payment of 25% of the net capital gain from the money the lawyer is holding. Once the certificates are issued, the rest of the money can be released back to you. However, 2 caveats, and this is where a surprise comes in. So it's very important to properly plan and budget for your Canadian sale. The processing of the applications can take over 6 months or around 6 months from the CRA. That means you don't have access to those funds for 6 months. Then the following year, we submit a non-resident Canadian return, and you are typically refunded a chunk of money because we include your deductible sale-related expenses, and then you're taxed on certain amounts on the capital gain. 50% up to $250K, 66.6% of any gain over $250K is included. So yes.
Then you won. Yep.
Yes. And also, so a lot of people are moving back to Canada after living abroad for a while. I understand there's a lot of strategic planning when it comes to repatriation as well. Can you tell me some information about that?
Well, it all begins with our usual regular meetings while we are creating a plan. Okay, whatever that plan might be. However, most of us will go back to Canada at some point, or maybe we go somewhere else. We don't know.
Yeah.
So the actual holding of assets is a key. You need to be somewhere where your money is professionally managed, in a safe, regulated environment, and protected, right? This may not be in the UAE, may not be in Canada. However, the world is full of good places, from Switzerland to Isle of Man. Anyway, so it really depends. But the moral of the story is we have platforms that we work with that enable the safe holding of your assets, your investments, and sometimes cash as well. And most importantly, too, that it gives me the option to designate a beneficiary on my account. So I have an account, I'm the sole owner of the account, right? If I pass away here in the UAE, and the money here in the UAE has to go through the laws of the UAE of a state. If my assets are held in Canada, different situation. Those platforms give me the ability to appoint my wife, my son, my daughter, whoever, as a beneficiary. So I am still the only owner of the account. Nobody can sign off on it except for me. But the day I die, this money can go to whoever I designate, can even go to a trust and have my trustee manage the disbursement of the funds.
Very important.
So it's complex in that sense, but I mean, everything is available.
Amazing.
Everything is available, yeah.
And Bassem, so thank you very much again for being here.
Ruby.
Tell us, how can we contact you?
My information will show on the bottom of the screen.
Amazing.
Reach out to me anytime you want.
Yes.
Reach to Ruby. Ruby, you know how to find me. If you want to reach to Ruby, you can reach Ruby, reach me. I know how to find her.
Absolutely. Thank you again, everyone. And if you're planning your departure or already a non-resident, reach out to us at 360 Global Tax to help with your biggest move. Our goal is to make taxes less taxing. See you again.